Welcome to the Old Dogs REI Network, where cash flow is king. Real estate investing, the means, so you can enjoy your retirement dreams. This is the show where we cut right to the chase. No sales pitch, no long monologues, just simple how-to real estate investing advice, so you can earn the passive income you need to enjoy your retirement today. And now, your host and chief old dog, Bill Manacero.
Welcome to the Old Dogs REI Network. I'm your host, Bill Manacero, and this is the show where 50-plussers and anyone else who wants to join us get solid, no sales pitch real estate investing advice to help generate real cash flow. This podcast airs twice weekly on Mondays and Fridays, and if you aren't already a subscriber, go to iTunes or Apple Podcasts, type in Old Dogs, spelled D-A-W-G-S, find our podcast, and subscribe. Well, we have a real treat for you today. We have a returning guest who is just absolutely filled with great information that you guys are going to want to know about because she is our resident tax expert here. Her name is Amanda Hahn. And Amanda has been on this show before, and you can look up her previous show. I'll have a reference here to it on the show notes. But she is a tax strategist and a real estate investor. And this is something that I recommend to everybody who gets a CPA. If you are a real estate investor, you should have a CPA that is also a real estate investor. Amanda combines her passion for real estate investing with her expertise, knowledge in tax strategies. Her goal is to help investors with strategies designed to supercharge their wealth building using entity structuring, self-directed investing, and income offset opportunities to keep more of what they make. Amanda has a highly rated book, Tax Strategies for the Savvy Real Estate Investor, on Amazon, and has been featured in prominent publications including Money Magazine, Talks at Google, CNBC's Smart Money Talk Radio, as well as Bigger Pockets podcasts. Amanda and her husband, Matt McFarland, have a passion for animals, too, and founded Animals for Armed Forces, a nonprofit organization that has helped to place over 1,500 shelter pets with forever homes. Wow, that's awesome. Well, Amanda, welcome back to the Old Dogs REI Network.
Thank you so much for having me, Bill. I'm so excited to be here and to talk to everyone about the craziness that's happened in the tax side of things.
Oh, man, you got that right. I'll tell you, I am so thankful you are my personal CPA here. No, seriously, because you have just helped me get through these. Last year it was a nightmare. And, you know, were we going to get extensions? Were we not going to get extensions? It just, everything about it was crazy. And I know that, you know, moving into this new year, now we have a new administration, we have some new laws, things that are coming up. And I thought, gee, you know, you're going to have to talk to our folks before they file their taxes here so that they can get the latest and greatest, because you have done well by me, and I'm sure that your information is going to be just solid gold for them. So, Amanda, wow. Tell us, before we get jumping into the tax issues here, maybe you can just tell us, you know, what you've been up to and how things have been going with your firm and so forth.
Yeah, well, you know, I think like most people, 2020 was a unique year with COVID and just, you know, changes at work and with investing. So thankfully for our firm, because a lot of our clients are all over the US. And so we kind of had it set up where we, you know, work with clients remotely. And from that perspective, you know, COVID, the whole stay-at-home orders hasn't really impacted the firm as much. You know, still are able to help clients all over the U.S. with planning and taxes and all that. But I will say, you know, at the very beginning, kind of this time last year, right, at the beginning of the pandemic, when a lot of people started staying at home and binge watching, you know, TV shows and Netflix. What I found myself doing was binge watching webinars, webinars from the AICPA or the state CPA board and just other CPAs about tax changes and and strategies
Wow.
and things like that.
That sounds like something I'd watch to try to fall asleep at night. I'm sorry. No, I'm just kidding.
I
Just
know,
kidding.
right? It takes
Very
special
special.
people to binge watch and enjoy all that kind of stuff. And so yeah, as crazy as it was, for me personally, it was, wasn't too bad of a change, and just really have to embrace all the changes. And in fact, a lot of the changes that came out under the CARES Act for 2020 were mostly beneficial to real estate investors. A lot of tax cuts and refund opportunities. And I think it's really important that we, kind of talk a little bit about those, because right now is the time when people are getting ready to file last year's tax returns. And for some investors who maybe didn't have such a great year, whether it's through the investing side or at jobs, there are a lot of opportunities to think about and talk to your tax preparer about, as you are getting ready to meet with your tax person in the, coming weeks or months to file last year's taxes.
Yes, and there's also rumors or whatever. There's a lot of things circulating about things that could affect us as real estate investors, and hopefully you'll maybe even address some of those kinds of things.
Yeah.
I'm really just going to hand this over to you and just give us the information that we need here. Just go for it. I'll throw in questions here and there as related, but yeah, mainly you're going to be carrying this.
Yeah, certainly. I think one of the main changes that came about under the CARES Act was that the IRS changed the rules for what we can do with tax losses. And so starting in 2018, there was a new rule that, a lot of the losses, if you had a loss in any given year, and by loss, we just mean, you had more write-offs and expenses than you did income, we could only carry it forward to offset taxes from future income. And one of the biggest benefits that came about under the CARES Act was that they changed that rule. And so between, if you're someone who had losses between 2018, 2019, or 2020, you were able to carry the losses back into previous years and effectively claim a refund for the taxes that you've paid in the past. And so, we found that to be very helpful for a lot of clients, because I think, a lot of people did have a not so great year, right, in 2020, maybe because your tenants weren't paying as much, or maybe people who, had their work hours decreased or even lost their jobs, but still had expenses, carrying costs and all that from real estate, which then created these large losses. And so that's certainly something to look at. If you're getting ready to meet with your CPA and filing your tax returns, and you do have a loss, one of the planning opportunities is to think about whether we should carry it back and get a refund, or if we should carry it forward to offset taxes from future income. So I think that's one of the main ones. But I don't know. I thankfully for us, we really haven't heard from a lot of our investor clients that said, that they lost a significant chunk of rental income under COVID. For me personally, I've been fortunate too that my tenants really didn't miss a lot of rent. I think I had, maybe someone missed like a month here and there, but nothing too significant. I don't know what your experience has been, Bill.
Yeah, I think most for me, as well as a number of people that I've asked that have been on the show, yeah, some people saw a slight decline. I didn't talk to anyone who was just devastated by it. I mean, we also have Airbnb, and our Airbnb got hit real hard for just really about a month or maybe 2 months. But for the most part, yeah, maybe some people had, 4 or 5% decline or something like that, but really that did not seem to impact most of the investors I've spoken with, as well as myself.
Yeah, yeah. And that's, it's kind of what we see too. And it's interesting you bring up the point of Airbnbs, because I don't own any short-term rentals, but I do have clients who said the same thing at the very beginning. Got a couple panic phone calls, where say, hey, all my bookings were canceled. I might expect a lot of loss. But what I'm generally seeing is that the profits that were made and the bookings that were made towards the later part of last year more than made up for some of that lost revenue in the early part of
Oh,
COVID.
it's so true. And not only that, but some people are even saying that Airbnb is taking a lot from the hotel industry. That has, for some reason, travelers feel more trusting in an Airbnb environment than in a
Sure.
hotel, which I don't quite understand, but I've
Yeah.
seen it in our own numbers. Yeah.
Yeah. Yeah, certainly. And I think as a, I mean, I don't have any short-term rentals, but I am certainly a client of short-term rental properties. And, especially when you're talking about family gatherings, it's like, our whole family traveling together or traveling with parents and even grandparents. There's certainly a lot, you feel like it's safer because you're sort of in your own space, right? Your own HVAC unit instead of being in a hotel
Right.
where centralized AC with a lot of unknown people and getting, getting into elevators with a lot of different people. So I think that's what you're seeing is the uptick, in people just opting for that route. One of the benefits of 2020 returns too, if you're someone who, had an Airbnb or started Airbnb, we still have the bonus depreciation. So if you were furnishing your rental properties, all that furniture, appliances, supplies that you purchase for the Airbnb, we're still eligible for 100% immediate write-off. So, that's a great strategy we've seen for some of our short-term operators where you might have really, really great cash flow, but you also have a lot of accelerated write-offs that you can take to then try to offset that taxable event from those good operations.
That's
Um,
great. Wow.
so yeah, certainly something to look at for any of you who are currently in short-term rentals or getting into it. I do expect to see a lot more people involved in the short-term rental space in the coming years. I think another significant change to the CARES Act was with respect to retirement accounts. And so in previous years, we really weren't able to access money from retirement accounts until you reach retirement age, right? Because if you did early, then, early distributions, not only do you have to pay taxes on that money, but you also had to pay penalties as well. So one of the tax benefits that came out under the CARES Act is we were able to tap into retirement money before retirement age and avoid the early distribution penalties. And that was pretty impactful for a lot of our clients who, maybe didn't necessarily need the money for living, but wanted to access retirement money so that they can instead use that for, real estate and other alternative investments. So if you were someone who did access retirement money and, were using it for real estate, do make sure that when you talk to your tax person or when you're meeting with them to let them know and discuss the possibility of, being able to avoid early distribution penalties. The rules regarding the CARES distribution from retirement accounts, though, is that you have to be financially negatively impacted by COVID. And if you met that requirement, then you can take a distribution of up to $100,000 from retirement account and avoid any early distribution penalties. One of the most interesting things that we heard from was, okay, well, financially impacted negatively, what does that mean? Do I have to collect X dollar amount less in income or how many months of no income? And that rule was actually very great. And so the government hasn't really ever, they never ended up defining what exactly that meant. So there's a lot of flexibility in, if your spouse had hours cut at their W-2 job, can you liquidate your retirement account? The answer is yeah, probably yes, because collectively you were negatively impacted at some point in time during the year by COVID-19. So if you're someone who did take a distribution, I would certainly talk with your CPA about the possibility of qualifying under one of those exemptions to then avoid the need to pay taxes and penalty on something like that. On a kind of a related note, they also allowed you to take 401k loans of up to $100,000, and usually the loan limit was up to 50,000, so they've essentially doubled that under the CARES Act. And similar rule where you were eligible for that if you were someone who were negatively impacted by COVID-19. And so, as we now get into tax filing time for last year, there are some decisions that you can make. So, meaning if you did take money out, whether to use it for real estate or for living expenses, even though you didn't have to pay penalties, you still potentially had to pay the tax on the distributions. And so, one of the benefits of this year is now when you're filing last year's tax return, you'll finally have an idea where you ended up in terms of taxable income. And so if you are using a lot of strategies to offset, your income in terms of depreciation and home office, car expenses, if you're writing a lot of those things off and creating a loss, then you might say, okay, well, maybe I'll just keep my money from the distributions and then, I'll use it to invest and buy more properties. On the other hand, if your expenses end up being less than what you anticipated because, business didn't do as bad as you originally thought it was last year, you do have an opportunity to put that money back into retirement to avoid the taxes on that. So I think that's going to be a key deciding factor for people who are meeting with their CPA and saying, hey, should I keep the money or should I put that back? And if you put it back, it doesn't necessarily mean you cannot use it for real estate. You can certainly put that back. Maybe you took it out of a work 401k. But instead of putting it back into the 401k, you can maybe instead put that back into a self-directed account, like a self-directed IRA or a self-directed 401k. And so by doing that, it essentially allows you to still have access to that money so that it can be used for real estate, notes, or syndications, and all types of real estate investments too. So I think from the investor's perspective, those are kind of some of the major changes from the CARES Act. Is maximize, if you did have a bad year, then make sure you're capturing those and basically turning lemons into lemonade, right? Try to get them in terms of refunds or offsetting taxes in the future. So yeah, never let a good loss go to waste if you had any.
Well, that's interesting. When you mentioned about the funds you take out of your IRA or 401k, so if you took $100,000 out, you could, in essence, and let's say you didn't use it, you could open up a self-directed IRA, or with the 100,000, so you wouldn't have like a contribution minimum or maximum or for that.
Exactly, that's exactly right. So it's kind of like for the first time, we had people who say, hey, my money has been stuck with my work 401k forever, right? And that was an opportunity to be able to move it towards the retirement account in a self-directed environment. And even if you're someone who, let's say you took it out, but you never put it back in yet, and now that you're on the podcast with us, you're like, hey, maybe I do want to put that back into a self-directed. You could still do that. You can do that essentially before you submit your tax return. And then you wouldn't have to pay taxes on the distribution. Now, let's say you already filed your tax return and you didn't put it back. Under the CARES Act, you were only required to pay taxes on a third of the profit of what you took out. So if you took out $100,000, you would only pay taxes on $33,000 of that this year, and then pay taxes on $33,000 that next year, and then $33,000 of that in the following year. So that's another benefit that the government allowed you to kind of delay the taxes over a couple years. But what's really great about that is, let's say you did pay the taxes on it, you have all the way up until year number 3 to then pay the money back into the retirement account. For our example, if we put into a self-directed, and then you can claim a refund on the taxes paid. So it's almost as if you never took the money out.
God, that's great. That's great. Wow. Well, keep going. What else? This is good stuff.
Yeah, I think those are kind of some of the main changes, again, just bonus depreciation, capturing the losses, and, making sure like if you took retirement accounts out, there's still a lot of flexibility in how to treat that between now and the time you file your tax return. There was also the change for those of you who are charitable minded, and I know Bill, you are for sure. Charitable donation deduction. We used to be able to write off up to 50% of our income in previous years, but under the CARES Act, they raised that up to 100%. And so that just means, if you're super charitable minded, your income last year was $20,000, you could have taken a tax deduction for up to 20,000 for charitable donations made and effectively wipe out the taxable income.
Gosh, that's it. That's amazing. Yeah, I didn't
Mhm.
know about that. Wow, that's great.
Yeah. And
Wonderful.
if you're someone that's involved in charities or doing a fundraising for charities, is certainly a huge piece to let people in the network know, right, that you are able to take a fairly significant write-off in terms of 2020 tax returns. And that's also available this year as well for 2021, in terms of the being able to increase your charitable donation deductions.
Oh, that's great. That's great. Well, what about and maybe you're going to address this or not, but one of the things that I know a number of investors are concerned about is 1031 exchanges, and
Mhm.
some folks use them regularly. It's an important part of their whole investment strategy. Is that still going to be around in 2021? Or have you heard anything? Do you know kind of where that stands?
Yeah, that's such a great question. I think it's a good transition to talk about what some of the proposed changes are. And there's so many, there are so many proposed changes, none of which seem to be beneficial for real estate investors at the moment.
Yikes. Yikes.
So with respect to 1031 exchange, yes, there has been talks that there are potential changes to 1031. There's a couple different schools of thoughts. I've heard professionals within our industry say, that they're never going to take that away. Why? Because a lot of people in Congress invest in real estate and they want the benefits, so they wouldn't do anything that's going to hurt themselves. Although there's probably, some truth to that, what I will say is what a lot of people don't know is his in the past, we were able to do 1031 exchange not just for real estate, but also for other assets as well, like businesses, business assets, maybe a car that's used for business. So I bet you probably didn't know that, right? You could sell a business car and you can 1031 exchange into another business car.
No, I didn't know that.
See?
That's
So you would
great.
be like 99% of the people we talk to, right?
Wow.
No one really talks about that, but that certainly was a tax benefit. And of course, you and I we're all here in real estate, and that's why we always talk about 1031 exchange as it relates to real estate. But historically, that is a strategy used for other types of taxpayers too, for businesses and things like that. And what happened was, as part of the Tax Cuts and Jobs Act, the 1031 exchange was limited. So after that tax change, 1031 exchange is now only allowed for real estate. And so you can see, even in the last round of changes, there's a pretty significant limitation now where we can only do real estate and nothing else. So it's probably prudent to assume that this very well could be a change coming up where 1031 exchange is eliminated. But that doesn't mean that's kind of the only option, right? There are other possibilities where they just limit 1031 exchange for certain transactions or certain taxpayers. I know one of the key things that we keep hearing about in the proposals are to limit tax breaks for those with income of over 400,000, right? And so what we don't know, we don't have clarity, is in the proposals, will they limit 1031 exchange, but only for those making over 400,000? Or is it going to be a straight across limitation of some kind? So that's unclear at the moment. But what we do know is that there's certainly a lot of groups and that who are lobbying to try to keep the 1031 exchange around, because like you said, right, a lot of investors have used that consistently in the past, as we outgrow our current portfolio and upgrade into larger, bigger, better properties. So our hope is that that stays around. But even if it were to go away, then the next best thing is to have it go away, not completely, right, but maybe newer forms of limitation.
Yeah, and I know some people have been using also trusts in that same role. There's a DST, not the Delaware trust, but there's another DST that is used for that purpose too, where there isn't a holding period. There isn't that where you have to make a decision within this period of time on what you're going to purchase. And I don't know a lot about it because I haven't used it myself, but I've had guests on that have used it real successfully. I know it's more expensive to do it that way, but it is sort of an alternative to 1031 that folks have used. Well, maybe I'll have a link in our show notes to. We had a discussion on that a while back. I might add in there as well. But I know there are other ways, but 1031, certainly. Everyone's so used to it. And it's...
Yeah, certainly. And there's also just offset strategies too, right? If they said, hey, you can't do a 1031 exchange anymore. Well, if I sell my current property, I can always just go out and buy new real estate. And then with my new real estate, I can take depreciation or accelerated depreciation and maximize my write-offs, where those write-offs will indirectly offset the capital gains from the sale of my initial property anyway, right? So
right.
I think, that's kind of how traditionally the tax rules have worked, right? They come up with a new limitation, and then there's going to be new strategies to sort of circumvent those new restrictions. If we're saying, hey, people who make over 400,000 might not be eligible for 1031 exchange, then the strategy is, okay, how do we all get it under 400,000? Right? What are some strategies to kind of meet that, meet that definition? So it'll be interesting. I think it'll be probably another year of, webinar binge watching for me, but I'm looking forward to that.
You and Matt just with the popcorn out, just kind of, what do we got today? All right.
Yeah, right.
That's hilarious.
Put it on a DVR.
Yeah, right.
But I think one of this kind of more alarming things is just kind of the statement where the proposals want to roll back what they consider unproductive and unequal tax breaks for real estate investors who again make over 400,000, and that's a very vague a vague description, because unproductive or unequal tax breaks could really mean all sorts of things. Like are they not allowing us to use depreciation anymore? Are they not going to allow us to claim real estate professional anymore? Really uncertain as to what exactly all of that means. And I think that's the toughest part for us as advisors, and also for you guys as investors, is there's so much unknown that for part of it, it's going to be difficult to plan. But we're hopeful that if there's going to be changes, that they occur in more of a phased-in approach, where, okay, we know here are the changes that are going to be signed into law, but maybe they don't take an effect until 2022, or they take into effect over the next couple years. And I think that's a very high likelihood of that occurring, because even though you hear in the media people talking about tax increases and things like that, but the reality is I think there's a lot more urgent tasks at hand that the government, or the U.S. as a whole, we're trying to deal with, right? The COVID-19, the vaccine rollout, and the economy, stabilizing the job market and all that. And so we're hopeful that even though there might be tax changes, that those come after these more urgent issues are addressed. So hoping it's going to be, 2022 or beyond. And then that will give us a lot of time to plan. We can say, hey, let's look at our portfolio and say, which ones do we want to sell and get rid of? Or, which ones do we want to do a 1031 exchange now before it's too late, right? Or we can't do it anymore.
Right, exactly. Yeah. Anything else coming up that that we should be aware of as well? I usually, take extensions because I really have to. It takes time to really just kind of go over things and look at where we're at. But
Sure.
Are there any other surprises, or you think that might come up that we should know before April 15th?
Yeah, I'm so glad you brought that up because, we usually recommend extensions, for our clients, unless you have a urgent need to get the return filed, right, for loans or whatnot. But filing extensions just gives you additional time to gather up your deductions and make sure nothing's missed. Especially for 2020, we are encouraging clients and investors to file or at least consider extensions. And the reason for that is because of exactly what we just said. There's so many pending potential changes in 2021 where if you file your tax returns by March or April, and let's say you decided to accelerate some write-offs and you claimed bonus depreciation and you wrote off as much as possible. But later on, we find out in the summer that, hey, 2021 tax rate is actually going to go up a lot. And then the issue you run into is, well, maybe that wasn't such a great decision after all to write off more than we needed to for 2020. If in 2021, on that income, I'm going to pay a lot more in taxes, right? So when you file extensions, it gives you that hindsight to say, okay, well, and I certainly know what I did in 2020, but now I have better idea in 2021, what are my transactions? What does my income look like? And also, just as importantly, what's the tax law, right? If my tax rate last year was 20%, but this year in 2021, it's going to be 39%. Well, maybe I don't want to accelerate my depreciation. Maybe I want to take the regular depreciation and save more depreciation towards the 2021 return when I can be saving taxes at 37 or even 39%. So in addition to just giving yourself more time, like you're saying, Bill, it gives you more clarity and hindsight this year. So we can say, hey, well, what's the best way to report certain things, or when do we claim certain expenses to get the optimal tax savings between multiple years?
Excellent. I think that's a really good point. Wow. That's, yeah, if taxes, they're going to be taking a bigger chunk of that that your profits or your income, then I could see why you'd want to defer some depreciation there. That's great. Great stuff.
One of the proposals that's coming up, that has come up was under the Tax Cuts and Jobs Act, we started having the flow-through entity tax break. And basically what that was for certain types of income that we make, up to the first 20% of that could be tax-free. So a good example will be if I'm a realtor and I made $100, or let's say I'm a landlord, right? And I made $100,000 of taxable rental income. Then it's possible that the first 20,000 would be completely tax free, and I only pay taxes on 80,000 of that. And so that applied to not just real estate, but a lot of other types of business income as well. It's so interesting because when that break first came out, there was a limitation. So if you're, someone who were of higher income, then maybe you don't get 20% of that tax free. Maybe you only get 10% or 15%. So the more income you make, the less tax free portion you'll get. But real estate investors, real estate brokers, realtors, fix and flippers, property managers, syndicators had a loophole. So for those people, even though they might have been higher income, they still got a pretty good chunk of that money to be tax-free. And probably from the lobbyists and, the previous administration as to reasons why real estate investors got those benefits.
Yeah, it didn't hurt to have a real estate investor in office at the time, right?
Exactly. So that was really great. We saw a lot of, tax savings from clients who were actively involved in the real estate side of things. But that is one of the proposed changes coming up, is that removing that loophole where real estate investors are just treated like, any other business owner, like Amazon seller or whatever. It's all going to be the same, where if you're making over 400,000, maybe that benefit starts to, go away or starts decreasing at some point. So, I think for that one, it's kind of just keep your eye on the, on the changes coming up. There's not really an action item because you're going to make as much money as you can in real estate, right, irrespective of taxes. But I just thought that was interesting in that we got a couple years where we got to be the exception to the rule and enjoy some really really great perks, and that seems to be the one that they're closing the walls on.
Ouch. Wow.
Yeah, I think one of the other ones that are coming up that we as investors should really, keep an eye out for. And I know this is not going to impact everyone or even a lot of people, but for the ones who do, might be very impactful. And that's the proposed changes to capital gains tax rates. So, right now our capital gains rate, if you were to sell a piece of rental property, could be anywhere between 0% to 20%. For most taxpayers, we're paying about 15% taxes on that, which is good because that's usually lower than what the marginal rate is that most of us are paying. So, and one of the proposals is increasing the capital gains rate from the 15 to 20% all the way up to the 39.6%.
Ouch.
And so
Wow.
that's a very, very significant increase. Now, that's the bad news. The good news, though, is it's at least in its current form that increase would only be for those who make over $1 million of income. Okay. So again, it's not going to be applicable to a lot of people, but could be applicable to some. And what we don't know is when they say $1 million of income, do they mean $1 million of W-2 or capital gains only? Or are they talking about W-2 capital gains and all of your income, right? Because that could be one where then applies to more people when you're looking at a year where you're working and you're selling a couple properties and you're no longer able to do a 1031 exchange, right? Then that starts to push more and more people into wow, am I going to have $1 million in total amongst all of my different activities?
Yeah, that is a tough one. Yeah, especially if you're counting rental income on top of that and everything else. That can be that could
Yeah.
be a hard one there, man.
Yeah. Yeah. Well, I mean, there are some good news though. I don't want it to be all, doom and gloom and, and scare everybody. So okay, so if I may, I will share some highlights of maybe potentially good news in the proposal that's coming
Yay.
up.
Okay. I'm up for that.
All right. So one of the benefits, so under the Tax Cuts and Jobs Act, which was the last round of changes that came about, one of the biggest detriments is that they started limiting the tax deduction for state income taxes that we pay, as well as property taxes for our primary home. So before we could deduct those, right? If you paid income taxes to the state and you paid property taxes for your primary home, we can write that off against income. There is no, ceiling on that effectively. But current law is that the total of those two taxes we can only write off up to 10,000, and so it has been really really detrimental to some of our clients who have homes located in more expensive areas and also paid higher amount in state income taxes, right? So specifically California, New York, some of these higher taxing states where maybe people were taking tax write-offs of 30 to 50,000, all of a sudden you're only able to write off 10,000. And so that's the current law, but there has been indications in a proposal to reverse that limitation. Hopefully that in going forward, we are then once again allowed to write off our property taxes for our primary homes as well as state income taxes that we pay without that $10,000 cap. So that's good news.
That's a good one. Yeah, there's some good news.
A sliver of a silver lining amongst all the bad news. Another one that was interesting that I thought is that they're proposing a brand new tax credit for those who are renovating distressed properties in distressed communities. And I believe what they're calling that is the neighborhood home tax credit. Again, this is just kind of in the proposal, so who knows if it'll come to fruition. But I think that's very interesting, especially for investors who are doing rehabs, doing the BRRRR strategy, doing forced appreciation. It'd be interesting and really a welcome, if we are to get those types of tax credits by helping to improve a property and improve on the neighborhoods. So that's one I'm really excited about to kind of see the details of how that will come out.
Yeah, that could be great. Now, would it have to be a designated, zone like, where the property is? I forget what they call it again. The
Opportunity zone
opportunity zone.
type of
Yeah,
stuff.
right.
Yeah.
Uh,
Yeah, it's interesting because in the opportunity zone, that was a specific one where, had to be an area identified, right, at the city, county, state level. This one we don't really know. So far they've just said distressed communities. So hopefully there's just a lower threshold in terms of, how they define that, rather than having to go to a map and, confirm whether this is within the definition of distressed or not.
right,
But yeah,
right.
that's a good question.
Yeah. Wow. Any others that we should know about, or anything else that you might want to, just so that we'd be better prepared for the tax season?
I think just, general comment I always tell people this time of the year is when you're meeting with your tax person, make sure that you bring all of your real estate documents, and specifically the main ones to make sure you're providing are the closing disclosures, right? We used to call them HUDs, right?
Yeah,
Back
right.
4 years ago,
Sure.
HUDs. We still call them HUDs, but I know now it's called closing disclosures. And it's that legal size, 3, 5 page piece of paper. And it's the reason it's important to provide that to your tax person is because that is the documentation that lists a lot of different line items, which are your costs in acquiring or selling a property. And one of the biggest mistakes we see is people meet with their tax advisor, and sometimes the CPAs are I don't know, too busy, or maybe they don't specialize in real estate, and they'll just ask you, oh, you bought a rental, how much did you pay? 100,000? Great. And that's the number that they use on your tax return. But under that methodology, then you just missed out on a bunch of different expenses you've incurred, right? Appraisals, closing costs, real estate commissions, title transfer fees. All those things are things that are deductible or depreciable. And so it's really important that you provide that document to your tax person so they can pull all of the relevant deductions from there, right? That could be thousands of dollars in costs that you might otherwise miss out on. And that's important for purchases, sales, as well as refinances. Last year, because interest rates were low, we've seen a ton of refinance activity. So if you did any kind of refinance, make sure you bring the closing disclosures to those transactions as well, so that your CPA can capture all of the associated costs with that. I think another one too, just, in general, I always like to remind people this time of the year, if you've made improvements to your property, make sure you provide a detailed listing of those improvements, because then your CPA can help you maximize the deduction and accelerate the write-offs as much as possible. So, you don't want to just tell them, hey, I spent $30,000 on Main Street rehab, because that doesn't really help them to break out which ones are eligible for bonus depreciation or other ways to have faster expensing. You instead want to provide them with, more of a schedule that shows, okay, of the 30,000, maybe it was 5,000 for drywall, 1,000 for flooring, 3,000 for cabinets, 1,000 for countertop, because then they can use that information to try to claim as fast of a depreciation as possible for you. So I think those are kind of just commonly seen errors that we see at tax return time.
Okay, this is great, Amanda. Some excellent information. Some of it a little depressing, but hopefully there'll be some offset here. Like you said, some of the things that may sprout up that'll help offset things. But really, really good information. Gosh, yeah, I can't thank you enough for being on. This has been really helpful, and hopefully the people listening, it's early enough that you can act on some of these things, or at least check out some of these items we discussed to see if they maybe moved on a little bit further along, or where they may stand, and in terms of your tax strategies. So, yeah, wow, Amanda, I'm sure there's folks that would want to get in touch with you or find out more about what you do, and maybe even are looking for a CPA right now. But what's the best way for folks to reach you?
I think the best place for people to find me is probably on our company website, and that's www.keystonecpa.com. That's KEYSTONECPA.com. We have a free downloadable ebook, and just some great, the latest information on tax changes. Like I said, we hope there won't be a ton, but if there are going to be, you'll find them on our website. So certainly check those out. And the one message I want to, kind of leave our listeners with is this time of the year is when we get a lot of phone calls. People are asking, "Hey, are you taking on tax returns? Can you do my tax returns?" And clearly the reason is because taxes are on people's minds, right? It's like, "Hey, we have to file last year's taxes." But the reality is, there at this point in time, there's not a whole lot that you can do to significantly reduce taxes for last year. I mean, we talked about some of the strategies, but there's not as many as you maybe could have done if you were planning ahead during the year back in 2020. And so now, though, we have an opportunity, right? We're still early in 2021. As you're getting ready to file your taxes for last year, also take this time to plan ahead and work with your CPA or your tax advisor on what are some of the things that you should be doing now on a monthly basis so that you can make sure by this time next year, you have already implemented all the strategies that are needed to really help you to save and reduce your taxes going forward, right? Because this is not just in focusing on what happened last year and reducing taxes, but we really want to be proactive and say, hey, we're only, early in the year in the first quarter. We have all the rest of this year to continue to invest, build our portfolio. But in the meantime, what are some of the things I should be doing to make sure I maximize all of my write-offs in relation to my real estate investing?
That's great information and great advice. I think it's so true that you're such an important person to that person that is investing. You need to understand as well sort of what our strategies are as you go forward, so you know exactly what we're looking to do. And I think that's the kind of relationship that makes for a good power team there to move forward. So good advice. Wow. Well, thank you so much for being on, Amanda. This has been just awesome. And, I would recommend folks that have questions go. You do have a lot of great resources on your site. So I definitely would check that out. And your book is fantastic. Bigger Pockets publishes it too. So they're very much in alignment with Amanda as well. So that's Tax Strategies for the Savvy Real Estate Investor. Well, before we go, we do have a tradition here, Amanda, and we're just looking forward to hearing you howl here before we sign off. And are you ready for this?
Oh my gosh! Yes, I guess.
I know it's one of those things that just won't go away. It's just
That's what makes you unique.
I guess.
It's unforgettable. Okay, are you ready for me?
We are all ready for you here.
All right. Ow!
That was great. Wow, that was awesome. I would not have suppressed that from this audience for anything. I mean, that was great. That was a great howl. Well, thank you so much for being on. This is great. Good timing, too. Hopefully right before the tax season here.
Yeah, wonderful. It was so much fun. Thank you for having me.
It's been my pleasure. And I want to thank all our Old Dog listeners out there, too, for joining us. I know there's a lot of other things you could be doing right now, but the fact that you've taken the time to join us means a lot, and we really appreciate it. Now, please note everything that Amanda talked about today is going to be presented in detail in our Old Dog show notes here at the olddogsreinetwork.com/blog area. You're just going to look for the episode with Amanda Hahn. Well, that's the show for today. Remember, cash flow is king and real estate investing the means. Until next time, keep moving forward and may God bless.
Thank you very much for visiting the Old Dogs REI Network. We would greatly appreciate if you would stop by iTunes and let us know what you think of the show. We would love if you could subscribe to the podcast, give us a 5-star rating, and write a review. The more ratings and reviews we receive, the more visible the podcast will be to others. Thank you.